Hello everyone and welcome back to my Forex channel. I hope everything is going well for you, and in today's session I will show you how you can identify divergence in the ahead of time and how you can use it into your advantage when you trade in Forex. In this video you will learn what divergence is, how to spot them, the various types of divergence, and last but not least how to trade using it. It may appear complicated, but I will do my best to explain everything in a clear and easy to understand manner so that you can put this knowledge into practice for yourself. Your support means a lot to me, so please consider subscribing as well as leaving a like or leaving a comment of your next video idea which you would be interesting to see. It really motivates me to create more of the great content for you guys, and of course you are more than welcome to join my free Forex group where we are not stopping to dominate the Forex markets. I will leave the link in the description box down below for you to check us out. To begin, we will define divergence. Divergence is a concept that allows you to predict a potential price reversals by indicating a potential trade opportunity in the opposite direction of the current market move because of its slowing momentum. Divergence identified over a longer period of time, such as on 1 hourly or even daily chart, is more likely to work out than divergence identified on a smaller time frame. In general, an indicator such as MACD, RSI, or stochastic will move in conjunction with the price. Therefore, if the price is developing new lows, the indicator will move along by creating new lows as well. Now that we have defined divergence, let's take a look at the various types of it. Whenever the price makes a new low but the indicator makes a higher low, this is referred to as bullish divergence. The connection between the lows on the price chart formed a downside angle. However, the connection between the lows on the indicator formed an upside angle, which normally results in price moving in the opposite direction, potentially leading to the long trade. And now I will show you a clear example of a bullish divergence on the chart so you can see how it looks. You can see that the price of the AUD NZD on a 4-hourly chart produces a lower low while the MACD indicator makes a higher low. This is a sign that a reversal may occur. So because we covered one example of a bullish divergence, let's examine bearish divergence, which may occur in this specific example. Bearish divergence occurs when the price goes up by forming a higher high on the chart and the connection in between them creates an upside angle. But the MACD indicator makes a high and a lower high, creating a downside angle in between them. It normally precedes price going in the opposite direction and presumably setting up for a short trade. Let's take a look at the real world example of bearish divergence on AUD NZD 4-hourly chart. As you can see, the price made a higher high while the MACD indicator creates a lower high. As I mentioned before, this shows that we may see a price movement in the opposite direction. So in this case, we had a bullish trend, now it's trending towards a downside. In my opinion, practice and time are required to spot divergence, and I highly encourage you to focus on how it works by studying the fundamentals if you are new to this subject. Once you have mastered the ability of identifying divergence on the charts and on the indicator you chose to work with, such as MACD, stochastic, RSI, CCI, awesome oscillator, then you can apply it into your trading. Now let's address the main reason we are here. So how to trade divergence? Well, there are several key elements to keep in mind while trading bearish or bullish divergence. Number one, the higher the time frame, the more reliable the concept is. I am not saying that divergence cannot be utilized on a shorter period of time, but caution is necessary. Number two, divergence must be used in a connection with a strategy that defines the entry, stop loss, and take profit levels. Please don't forget that approaching various time frames for analysis increases a potential higher success rate. And for example, you may search for divergence on a higher time frame to identify an upcoming trend, and by using a simple trend line break to enter on a lower time frame. This may provide you with a low risk entry point to enter the higher time frame trend. As you can see, I have highly volatile Forex currency pair AUD and ZD on a 4-hour chart. As for the currency pair itself, it has all the characteristics that a day trader demands. The AUD and ZD pair is an excellent match for your trading system, since there are a few or even not many factors that may disrupt your strategy. At the bottom, we have MACD to help us to identify the bullish divergence. The chart's black line indicates divergence itself. Pay attention that the AUD and ZD chart closes with a lower bottoms, therefore the MACD creates the higher bottoms. As a result, the price movement and the MACD indicator show a significant bullish momentum. As we can see, the squeezed pattern was broken by a push and exhaustion, and we have a closed bullish engulfing candle on a recent horizontal area of the sensitivity, indicating a bullish pressure. In addition, we can see a beautiful MACD crossover, meaning the blue line is higher than the orange line, providing more confirmation. And to quickly go back when I mentioned about using the strategy and simple trend line break, this is what I actually meant. As you can see, we had a trend towards a downside, but that was totally broken by a bullish pressure. We had a push exhaustion to the previous area of sensitivity. We had a nice bullish engulfing candle closure, and our trade went towards an upside, reaching more than 160 pips into the profit. Please keep in mind that you cannot trade divergence alone. Strategy and additional tools may be also implemented to get a better, wider picture of the current market situation. As you can see, I added a moving averages. That's what mostly I use when I'm trading Forex. The moving average of 25 and 50 works the best for me on any currency pair I'm trading on. But again, guys, you can use any indicators you wish to, but as long as you applying that in the correct way, using correct management, top-down analysis, I am pretty sure you will be a successful trader if you put this into the practice. And the last bit I want to say, of course, if you see divergence in a sideways market, avoid trading it and instead wait for the range phase to end before you're looking for a better entry opportunity. So I hope you have learned something from this video. If you did, smash like and comment down below. And of course, if you do have any questions for me or you have any video suggestions on the Forex topics you want me to cover on, leave a comment as well. Contact my social media and I will definitely get back to you. So once again, guys, thank you for watching me, and until next time, bye.